Okay, in Chapter 8, we're going to be looking at the translation of foreign currency financial statements. So what happens when the subsidiary is in a foreign country? They're presenting their financial statements on the foreign accounting practices in a foreign currency. What does the United States parent need to do in order to properly report the financial statement information of the whole company on a consolidated basis? First of all, to prepare worldwide consolidated financial statements, a U.S. parent must 1. Convert the foreign GAAP financial statements. It's probably the international standards statements of its foreign operations into U.S. GAAP at this point because we are still operating on U.S. GAAP. Then once they do that, we have to translate the financial statements from the foreign currency into the US dollars. Now this conversion and translation process is required whether the foreign operation is a branch, a joint venture, majority-owned subsidiary, or affiliate accounted for under the equity method. So what we're saying here is it doesn't really matter. It's just not subsidiaries that need to this process has to be done with. Now, how do we do these translations? Well, there's two major approaches, and on page 366 we want to make sure we understand what this current and historical items are. And under exchange rates used in translation, there's the historical exchange rate. Now, the historical exchange rate is the exchange rate that existed when a transaction occurred. The current exchange rate is the exchange rate at the date of the financial statements, so of the balance sheet. So depending on what method is used will determine do you use the historical exchange rate or the current exchange rate. Now, what's the big deal there? Well, a lot, because the date of a transaction, we say, oh, that's historical cost, right? So in a foreign currency, that's a historical cost. But at the balance sheet date, that historical cost may or may not still be in place because foreign currency exchange rates change over time, which results in a gain or a loss on translation, depending on which way it moves. So we are going to focus on how do we determine the gain or loss in currency translations every year, and where do we report it? A gain or loss, is it reported on the income statement or is it reported in other comprehensive income? Now, as you can see there are two methods that are acceptable, the temporal method and the current rate method. Now, we're going to be talking about why you would pick either one, but GAAP accepts either one at the current time. Here's what you would use exchange rate wise to convert from the foreign currency to the dollar. Cash, marketable securities, and inventory at market, you would use the current rate under the temporal method. Inventory, prepaid expenses, property, plants, and equipment, and intangible assets use the historical rate, exchange rate, meaning the exchange rate at the time the asset was purchased. Current liabilities use the current rate. Deferred income uses historical. Long-term debt, current. So you see more of those cash items use current. Now, capital stock and additional paid-in capital use the historical. Retained earnings, you're going to see we actually calculate it. It's a composite of different rates. And then dividends, you use the historical rate at the date of the dividend under the temporal method. The income statement under the temporal method, you convert revenues and most expenses by the average rate for the year. Cost of goods sold under the temporal method uses a historical, as well as depreciation and amortization. Now, under the current rate method, it's mostly the current rate. You could see there, almost all assets and all liabilities use the current exchange rate to convert from the foreign currency to the dollar. Its capital stock and additional paid-in capital and dividends are treated the same as under the temporal method. As far as the income statement conversion goes, use the average rate for the year. So the temporal method is more of a complex method. It's more involved because you're using different types of rates, where the current rate method is pretty straightforward. Now, the two major translation methods and the two possible treatments for any translation adjustments give rise to four possible combinations. Under the temporal method, if you have a gain or a loss in translating your balance sheet and income statement items, under this method, does it go in the income statement or can it be another comprehensive income? The current rate translation method could also come to a gain or loss. Do we put it on the income statement or do we put it on other comprehensive income? On page, let's get through there. We're moving along here. Oh, it's back here. Oh, no, it's not. It's up here more. Let's see. Page 375, it gives us our answer in 374. Under the temporal method, you use the gain or loss in net income. You use combination A. Under the current rate method, you use combination D. Now, who should use the temporal? Who should use the current rate? If a subsidiary uses a US dollar perspective to translation, so most of their transactions are already recorded in US dollars, they use the temporal method. If the subsidiary has more of a local currency perspective, so they operate independent of their US parents, they'll use the current rate method. So once again, there's some judgment here on management, okay? And that's important because under the temporal method, any gain or loss in translation is in the income statement. Under the current rate method, it appears in comprehensive income in the equity section, so it totally misses the income statement itself. Now, to determine whether a subsidiary is integrated with the parent or operates independently, we look at the functional currency. So a company's functional currency, the subsidiary's functional currency, is the primary currency of the foreign entity's environment. So if they primarily use foreign currency in their daily activities, or if they use the dollar. Now these are some of the indicators we look at. So an auditor would look at it from their perspective also. If the cash flow is primarily in the foreign currency and doesn't affect the parent's cash flow, that's a foreign currency. If it directly impacts the parent's cash flows on a current basis, then it's the parent's currency. Sales price is not affected on a short-term basis by changes in the exchange rate. Foreign currency is the primary currency, the functional currency. The sales market, active local sales market. If the sales market is mostly in the parent's country or dominated by the parent's currency, then the functional currency would be considered the parent's. Same with expenses. Financing, if it's primarily done in the foreign currency. Intra-entity transactions, if there's a low volume of them between the foreign subsidiary or the foreign entity and the parent, more of a foreign currency approach. If it's the parent's, if it's more a high volume of intra-entity transactions with the parents, then it's more of a parent's currency. So you have to look to see what's the functional currency. Depending on the answers to these types of questions will determine if it's the foreign currency or the parent's currency. If it's a foreign currency as the functional currency, you're going to take the current rate approach to translating the subsidiary's financial statements into the parent's, into United States dollars, I should say. If it's the parent's currency, you're going to use the temporal method. Now, In highly inflationary economies, and they'll be defined, and this is talked about on page 377. So if there's a subsidiary, they mention Venezuela here, that has high inflation, when its cumulative 3-year inflation exceeds 100%. With compounding, it equates to an average of an approximately 26% per year for 3 years in a row. If it is classified as a highly inflationary, no matter what, you use the temporal method. Now, how do we approach this? We're going to take a look at the current rate method first. So under the current rate method, all revenues and expenses once again are translated in the exchange rate in effect at the date of the accounting recognition. The weighted average exchange rate is used when revenues and expenses have been recognized evenly throughout the year. When an income account, such as a gain or loss, that occurs at a specific time, you use the date, the exchange rate at that date. So if there was a sale of a plant asset on a specific date. Depreciation and amortization expenses are translated at the average rate for the year. They're looked at happening throughout the year. Now, these expenses accrue evenly throughout the year and could be delayed until year end for convenience. Okay, so these are our steps. We're looking at the income statement first. How do we translate that income statement from foreign currency into United States dollars? Under the current method. So if we take an example, U.S. company forms a wholly owned subsidiary in Switzerland, a Swiss company, on December 31st, 2012. Now, this is the example given in your book. So you'll see this on page 379 and 378. On that date, the United States parent invested $300,000 in exchange for all the subsidiaries' common stock. So they gave the Swiss company $300,000. The exchange rate was 60 cents per Swiss franc. So 1 Swiss franc equals 60 cents US dollars. So that would have equated to 500,000 Swiss francs, which 150,000 was used, of those francs was used to purchase inventory. The remaining 350,000 of francs, the CHF, Swiss franc, was cash. So that's how they began operations. They began their operations then on January 1, 2013. They have those two assets in francs and equity of 500,000. So they have net monetary assets of 350,000, 150,000 of inventory. When I say that, it's in francs. So that's where we begin. Now, during the year, these are the exchange rates that occur. As of January 1, 60 cents. They bought some property, plant, and equipment during the year when the exchange rate was 61 cents per franc. They bought a patent on April 10th. That's 62 cents per franc. The average translation was 65 cents per franc. When dividends were declared on October 1, the exchange rate was 67 cents per franc. Average fourth quarter, 68 cents per franc, and then December 31st exchange rate was 70 cents per franc. So these Swiss francs steadily appreciated. It took more United States dollars during the year to get 1 franc. So we need this information, and it is tracked. The first step in translating a foreign currency financial statement is to determine the functional currency. So we're going to assume here that the Swiss franc is the functional currency. Because of that, we are going to use the current rate method to translate those financial statements to US dollars, because that is what GAAP allows for. So here's how we will translate Swissco's December 31st income statement. First of all, they're presenting them in francs, 4 million francs. Under the current method, all of your items on the income statement are translated at average exchange rate during the year, which they gave as 65 cents per franc. So we'll convert those into US dollars, multiply the 65 cents times the 4 million francs, and you get $2.6 million. US dollars. And you continue to do that process. So when all is said and done, net income in US dollars for the Swiss subsidiary would be $305,500. Remember, we're using the average rate throughout the year when we translate an income statement at the current rate method, because the functional currency is the foreign currency. Okay, there we go again. Everything's used for the average. Now, the next financial statement we're going to convert is the statement of retained earnings. That is converted a little differently. It starts at 1/1 of 2013 because it's a brand new company at 0 retained earnings. Net income is determined from above. So whatever you got from your income statement translation is what you put into net income. Now, everything on the income statement was translated at average exchange rate. So if we take the 470,000 francs here and use the average rate throughout the year, just verifying, you will get 305,500 in US dollars. That's not the case though when we use the temporal method. So we'll see that in a few minutes. Now the dividends, remember, under this method, even though it's called the current rate method, we still use the historical rate at the date the dividends were declared. So at dividend declaration date, it was 67 cents per franc. So it was 150,000 francs that were given out, 67 cents, that translates to $100,500. Finish your computation in US dollars. Retained earnings at December 31st, 2013 will be $205,000. Now we move to the balance sheet. Now under the balance sheet, the current rate is used, not the average rate. The current rate is used at the date of the balance sheet, which came out to be 70 cents per franc. So just multiply that 70 cents times the number of francs in each category. You'll see there your total assets come out to be $1,169,000. Then we convert the accounts payable and the long-term debt at the current rate, which come out to be $595,000. Now, we finish off by doing common stock and additional paid-in capital. They're always converted at historical rates. Always, even when you're using the current rate or the temporal. So we look and see when was the common stock and additional paid-in capital accounts or amounts in those accounts established. That's the exchange rate date we use. So it was 60 cents per franc. So your common stock and additional paid-in capital come out to be $300,000. Add in your retained earnings. Now, once you do all that, $595,000 were your total liabilities, plus your $300,000 of common stock and additional paid-in capital, plus your retained earnings. At this point, your assets should equal liabilities and equity, but they're not going to, because you use different rates for different conversions. So now you have to figure out, how much am I off by? Well, assets are $1,169,000. Your liabilities and equity are $1,100,000. So you have a $69,000 translation gain. This is put in as a cumulative translation adjustment in retained earnings under the current method. It does not affect the income statement at all. At all. Okay, so under this method, you could go through the whole process and find it and add it in as a translation adjustment on your financial statements to show that there was a translation gain. Now, on page 382 is a detailed computation and illustration of your translation adjustment of the 69,000. There it is again. There we go. These are the things that I was talking about. Remember, we're not converting the retained earnings statement again. Our balance again, we're taking it right off whatever we converted on the statement of retained earnings. Okay, and then we have the cash flow statement, which I'm going to kind of fly over that. You can see operating activities are converted at the average. Your investing activities and financing activities are done at their historical. So you would need to know the dates of those cash flows. I'm just going to keep moving along here. And there it is once again. If you wanted to do this on an aside, like we did in the book here, your net asset balance in francs is 500,000 francs at the beginning of the year, converted to $300,000. Your change in net assets would be your net income minus your dividends. So your net asset balance at the end of the year is $505,000 according to that computation, adding net income and subtracting dividends declared. If you take your net asset balance at 12/31/2013, which is the equity, convert it at the current rate of 70 cents and take the difference. That's how much your gain is. You have a translation gain. So if C is greater than D, oops. Yes. If C, so the beginning of the historical, that the net asset balance at the normal translation, I should say, is more than at the current exchange rate, you have a loss. If it's less, you have a gain. Okay, so that's the current method. What if you use the temporal method? So if the subsidiary's functional currency is the US dollar, then any balances denominated in the local currency must be remeasured. Remeasurement requires the application of the temporal method. The remeasurement gain or loss goes on the income statement. Different approach. So let's take a look at how we would calculate this. First of all, the temporal method remeasures cash, receivables, and liabilities into US dollars using the current exchange rate. So you start with the balance sheet. Inventory, property, plant, and equipment, patents, and contributed capital accounts are at historical rates. This will result in differences in total assets and liabilities plus equity, which must be reconciled, resulting in a measurement gain or loss, just like under the cash method, or the current exchange method. Difference here is this gain or loss is measured on the income statement. Now assume Swissco's functional currency is the US dollar instead. The Swiss franc financial statements must be remeasured into US dollars using the temporal method, and the remeasurement gain or loss is reported in income. In that case, it is easiest to remeasure the balance sheet first. So if you notice, under the current method, we went income statement, retained earnings statement, balance sheet. We're doing the opposite here because we need to determine our adjustment to go into the income statement. And here we go. So under the temporal method, remember again, the balance sheet, cash assets and liabilities are remeasured at current rates. So cash and accounts receivables, because they're cash assets. Liabilities, all liabilities, are remeasured at the current exchange rate on December 31st, 2013. Inventory is remeasured at historical, the date of the inventory. Now in this case, the ending inventory is actually measured at the average historical. That's what it's measured at for the fourth quarter when it was purchased. So the assumption is it was purchased evenly over the last quarter, and you could see this on page 385 and the bottom of the last sentence on page 384. Okay, so that 68 cents is what that represents. Now the property and equipment, we could go pin on a date, and we could take the translation on that date. Same with the accumulated depreciation. So any depreciation related to that property, plant, and equipment is translated at the same historical exchange rate. Patents, the same thing. We know on the date we purchased the patent that it was 62 cents per franc exchange rate. So we multiply out those rates to get total assets of 1,076,800. We then translate all of our liabilities at the current rate on December 31st, 2013. Those total liabilities are still at 595,000. We translate our stock and paid-in capital at the historical rate exchange rate on the date that they were sold. So 100,000 and 400,000 francs were converted 60 cents each. Yes, 60 cents per franc, and you still have $300,000. Now, we now determine how much we need in retained earnings to get assets equal to liabilities and equity. So yes, it's plugging. It says to balance there, and that's essentially what it is. So in order for our liabilities and equity to equal 1,076,800, our retained earnings ending balance will be 181,800. That's assuming we converted everything correctly. So one more time, cash assets and liabilities current rate, inventory average fourth quarter rate, and then your property, plant, and equipment and patents and stock are done historical rates. Retained earnings is plugged. Now okay, all right, let's take a look at page 384, and you're going to see, which they don't have, but I want to show you the retained earnings statement. We actually have to determine net income next by backtracking in our retained earnings statement. So for this company, Swissco, we just started no retained earning balance at the beginning of the year in US dollars. We know that they paid out dividends of 150,000 francs when conversion was at 67 cents, or we should say they declared them that day. So we could make our adjustment accordingly, and we know the US dollar value of those dividends was 100,500. We also know from just doing our calculation on our balance sheet, our final inventory balance, or I'm sorry, final retained earnings balance must be 181,800. So we need net income. We plug it in, must be 282,300, because 282,300 minus 100,500 gives us a retained earnings balance of 181,800. So we converted the balance sheet to find out what retained earnings must balance. Now we converted retained earnings to find out what net income must equal. Now let's get our income statement together. The reason we're doing this is because the gain or loss from translation appears on the income statement. So it is actually part of the computation to get to net income. So sales are converted at an average conversion rate for the year. That's the 65 cents. That was our average conversion rate for 2013. Cost of goods sold is calculated. And I think on the next slide they'll show you that calculation, but we're going to look at the calculation on page 385. This calculation is trickier than for current rate method because some uses historical cost, some average cost. So here's what we do. Since we know all the beginning inventory occurred when the conversion rate was 60 cents per franc, we take beginning inventory times the 60 cents per franc, so that was $90,000 US dollars. We then convert the purchases for the years in francs by the average conversion rate for the year of 65 cents per franc. So our purchases amounted to $212,500 in US dollars. We then subtract ending inventory at an average for the fourth quarter, because the assumption is here that the inventory was purchased evenly throughout the fourth quarter. So we find an average exchange rate for just the fourth quarter. So 400,000 francs times 68 cents per franc, $272,000. Subtract your ending inventory from your purchases plus the beginning inventory, and you get a cost of goods sold of $1,930,500. So it's not an easy, oh, it's 70 cents per franc. You have to calculate it. Beginning inventories at historical, purchases at your average rate for the year, and ending inventory, it all depends. It could be a one-day purchase, or it could be an average for the fourth quarter. So you would need to look at that. Now, notice, we're not going to be taking gross profit now and using an exchange rate for that. No, now we're going to focus on the US dollars column. Subtract cost of goods sold from the sales in terms of dollars to get our gross profit in terms of dollars. Now, depreciation expense is converted at the historical rate when the asset was purchased. So the historical rate on that date was 61 cents. So whatever we converted the plant assets for, we'll convert depreciation expense the same way, $61,000. 62 cents per franc was the exchange rate when the patent was purchased. We'll convert the amortization expense at that rate. That's what I mean. It's a little bit more complex, detailed, more steps. All other expenses are converted at the average rate for the year under the temporal method. Add those expenses up, subtract them from gross profit. So notice we're not converting the 670,000 francs by using an exchange rate. No, because we're converting different components within the income statement at different rates. So it's not as easy as the current exchange method. So we'll come up with basically operating income of $459,300. I'm sorry. No, we're not. Yes, we are. $459,300. Now we're going to convert the income taxes at the average rate for the year. So the average 65 cents per franc, $200,000 of income taxes, $130,000 of income tax. Now if we just take that according to our conversion, 459,300 minus $130,000. Our net income should be $329,300, but it can't be. Okay, we have to subtract from it what we need net income to be, $282,300. So there's actually a $47,000 translation loss from converting the foreign subsidiaries' financial statements into US dollars, from francs to dollars. And we remeasure and show that loss on the income statement itself. So we plug that in to get from what our translation got our net income to what our net income needs to be. They do a detailed computation of that on page 385 to show you how it really is 47,000 by converting monetary assets and the other assets involved and comparing them to, if we just took all the net monetary assets of $520,000 in francs, converted them at the current rate on December 31st, 2013, that's supposed to be, it would have been 364,000. Our conversion. And there's that that cost of goods sold area and how we determined it again. There we go. That's what we were just talking about. There's your retained earnings conversion. And there's our detailed determination of the remeasurement loss. Once again, net monetary assets at the beginning of the year were $210,000. 350,000 times 60 cents. The increase in monetary assets from sales were $4 million at 65 cent a conversion. Purchases, your expenses, your income taxes, all being converted at their historical rates or some type of average. Acquisition of your patent, your PP&E, and your dividend declaration would lead to net monetary liabilities of $317,000. Net monetary liability, because it ends up being negative. Net monetary liabilities francs are 520,000 times the current rate of 70 cents would have given us a $364,000 conversion. So our conversion led to a loss. And that's the temporal method. It's also of cash flow. In remeasuring the statement of cash flow, the US dollar for net income is taken from the remeasured income statement. Okay, so that's that 282,300. And then you go through and use the different rates. You could take a look at that. I'm not focusing on that as much. I'm focusing on that balance sheet, income statement, statement of retained earnings. And there's your conversion for Swissco under the temporal method. So remember, we have the current rate and the temporal method. Current rate is used by the foreign subsidiary, or when the foreign currency is the functional currency of the subsidiary. Temporal is used when the US dollar is the functional currency. And we looked at the requirements to determine what the foreign currency is for that subsidiary. There's your statement of cash flow. Okay, so if the Swiss franc is the functional currency, consolidated net income, total assets, and total equity would be higher than if the US dollar was the functional currency under the temporal method. So you see that? You can see that the current net income using the current rate method is 305,500 under the temporal 282,300. And if you're sitting there saying, but they're the same thing, it's the way we convert it. So there's actually an 8% increase in the methods, just how we report net income. Total assets would be reported at a higher rate of 8.6% more. Total equity, 19.1% more. The return on equity, however, would be higher under the temporal method. So there's a decrease in the current rate. If any accounts of the foreign subsidiary are denominated already in a currency other than the local currency or the US dollar, they would first have to be restated to the local currency. So you have even more issues if that's the case. Both the foreign currency balance and any related foreign exchange gain or loss would then be translated into the US dollar. So there's even more complexities that could occur if a foreign currency does record any transactions in a different currency than what their functional currency is considered. Okay, so that's the guts of our chapter there. Now, of course, we have hedging, right? Hedging can be done to offset this balance sheet exposure, because you saw there our net income went down 47,000 in translation in one method, and then our assets were higher in the other method. Translation adjustments and remeasurement gains and losses arise from, and we know this, exchange rate changes and balance sheet exposure. Balance sheet exposure can be hedged through derivatives, just like we saw in the past chapter, either in forward contracts or foreign currency options, or through non-derivative instruments, foreign currency borrowings. Ironically, in seeking to avoid unrealized translation adjustments, realized foreign exchange gains and losses can occur. Now, and what are they talking about? Remember, this translation adjustment is not realized in cash. You didn't lose cash on it. It's just saying you would have lost cash if you basically liquidated everything. But you're not. So it's an unrealized translation. It still needs to be shown, but it's not real. Only if a liquidation occurred on that day. But these contracts, forward contracts or foreign currency options, can be real. And they can actually incur a gain or loss, which could affect the company. So we got to be careful of these things. So what happens now once we start converting? On January 1, convert a foreign subsidiary, and now we have to consolidate them with the parent. You know, it's bad enough we had to convert, now we got to consolidate. On January 1, Altman Inc., a U.S.-based manufacturing, acquired 100% of Bradford. Altman paid 25 million pounds, which was equal to Bradford's fair value. Bradford's balance sheet on January 1, 2012 was as follows. Okay, so this is also illustrated on page 391. Now, the $2,300,000 excess fair value over book value results from undervalued land, part of plant and equipment, and is not subject to amortization. Altman uses the equity method to account for its investment in Bradford. Okay. First of all, on December 31st, 2 years after the acquisition date, Bradford submitted the following trial balance for consolidation. Credit balances are in parentheses, so this is in terms of pounds. Cash, accounts receivable, inventory, property, plant, and equipment, accounts payable, long-term debt, common stock, retained earnings, and there's their income statement information. Although Bradford generated net income of £1,100,000 in 2012, it declared or paid no dividends that year. Other than payment of dividends in 2013, no intra-entity transactions occurred between the two affiliates. Altman has determined that the British pound is the functional currency, so we could use the current rate method to do the conversion. Now here are the relevant exchange rates on January 1, 2012, 151, December 31st, 156. The average is 154 for 2012. Remember, we're going to be working in 2013 also, so we need their exchange rates as well. All this information is listed on your book on page 391. That's what's nice about these slides. So, our first step. The initial step in consolidating is to translate its trial balance from British pounds into US dollars. Because the British pound is the functional currency, we're going to use the current rate method. The historical exchange rate for translating Bradford's common stock and January 1, 2012 retained earnings is the exchange rate that existed at the acquisition date, 151. So that's why you see that happening on the bottom of page 391. So we're going to translate on December 31st, 2013, the assets, liabilities, as you can see there, and common stock. Now, we're going to do that at the current rate, except for the common stock, which will use the historical rate. Now, the retained earnings balance on 1/1/2012 for this company was £2,700,000. We convert that beginning retained earnings at historical cost because we bought an existing company here. The parent bought an existing company. It was $1.51 per pound was the conversion. So that's $4,077,000. Net income is converted at an average rate, because under the current method, that's what you use for the whole income statement. So the retained earnings balance at December 31st, 2012, $5,771,000. Now, we take the 918 plus the 4, oops, let's keep going here. So, net assets on 1/1/2012 equated to $34,277,000 because when we bought them, that was the historical. We add the net income for the year at an average for 2012, $1,694,000. So the net assets at December 31st, 2012, $35,971,000. The net assets at the current exchange rate on December 31st, 2012 would have been $37,128,000, which leads to a positive translation and an increase in value, really, of $1,157,000. Okay, now we start the next year with the net assets at $37,128,000. We add to that the net income because they've already been written up essentially to 1,157,000, and add average net income for the year. That's like I said, under the current exchange rate, you could take net income in terms of the foreign currency and translate it just by using the average exchange rate for the year. So that would be $6,122,500. Translate the dividends from pounds to dollars by using the rate at dividend declaration date, which was $1.58 per pound. So $1,185,000. Net assets for the year would be $42,065,500. If we take 27 million pounds and convert it at the current rate, it would have only been 41,310,000. So we actually had a negative translation adjustment here. So the combination of those 2 years would lead to a cumulative translation adjustment of positive 401,500. Remember, under the current exchange method, you are using the comprehensive income area of equity to store your gain or loss on translation. So, the following journal entries would need to be made to the investment account, because remember, we still have the investment account involved here. We would debit the investment in Bradford for the $1,157,000 gain that resulted from the translation in 2012, credit the translation adjustment area on the equity area, $1,157,000. Remember, that's a comprehensive income item. In 2013, though, we would debit the translation adjustment account and credit the investment for the loss. So we do journal entries during this. These are the types of journal entries you would do during the consolidation process on your worksheet. And there they are. So you can see here the cumulative adjustment would then be the cumulative adjustment on Bradford's books would need to be eliminated and taken out of the investment account during elimination. And item E revalues the excess of fair value over book value for the change in exchange rate since the date of acquisition, with the counterpart recognized as an increase in the consolidated cumulative translation adjustment. So let's take a look here. US dollar equivalent at 12/31/2013 on 2.3 million pounds. Valued at $1.53, valued at the date. The fair value over book value was 2.3 million pounds on the date of purchase. So the US dollar on the date of purchase was at 151 for 1 pound. On the date of the balance sheet, it's $1.53. So there was actually an increase in value according to foreign translation, where we would have to increase our cumulative translation adjustment 46,000 and increase property, plant, and equipment. If you go back, remember the book value and the fair value were different by that 2.3 million. Why? Because of increase in value in the property, plant, and equipment. And as part of our journal entries, we cannot forget about that. So we have to increase it, but we also have to account for the increase from exchange from the two dates. So these are the two additional type of entries that would need to be made at consolidation. IFRS and US GAAP are consistent on most points. However, IFRS has a hierarchy of characteristics for determining functional currency, and the method used to translate statements from a hyperinflationary country differs. So basically, they do follow, you translate according to the current rate and the temporal rate, depending on what the functional currency is of the subsidiary. So our summary. The translation of foreign currency financial statements is an important accounting challenge. We could see that. And from your comments on Chapter 7, you can see it gets complex. But it's important to know because the world is global. You know, businesses are dealing all the time with foreign subsidiaries. The two primary methods used are the temporal and current rate methods, and we looked at both in detail. When the foreign operations functional currency is their local, use the current. When it's the US dollar, we use, or if it's a high inflationary economy, we use the temporal. We continue to do our consolidation once we translate, and we add any additional journal entries that would be necessary because it is a foreign subsidiary in our consolidation process. I strongly urge you to take a good look through pages 393 and 394 and make sure you understand where these numbers are coming from. Also, the comprehensive problem at the end of the chapter is invaluable for helping you really see a good example of the differences.